Let's talk to Mike van Dulken. He is the head of research at Accendo Markets, and I think it's fair to say we're going to be looking at some quite horrible-looking charts in the next 5 minutes or so. Morning to you, young Mike.
Good morning.
Right, let's kick off with BT, British Telecom of old. It only seems like yesterday that they were being privatised. That's a ghastly-looking chart, isn't it?
It is, and that's only the last year. So of note this week was the breach of February support around there 224. We're already testing 220. There's multiple trend lines we can draw on this chart over whatever timescale. But for the moment, there might be a bit of support around 215, but we're talking very tentative. And I think the clearest thing, if we can move out to the longer term,
so if we move on to the next slide,
is that this trend is unperturbed for the last 2 years, and we're now 2.25 years. And there's a lot of people in this stock from a very long way back who need a very significant, not just a bounce, but indeed a breakout beyond that trend line of falling highest resistance. So, you know, from £3, we need to get above 280. I mean, that is a significant...
To get some sort of reversal signal.
To get some sort of reversal signal.
Wow, yeah.
So you're talking, you know, 10, 20, 30, 40% rebounds before anything meaningful. And my concern is that we've gone from a widest channel into something narrower, which may well remain the case for a good while longer. And I see very much the potential there. As I said, maybe a slight bounce or a bit of support from 212. But you'd have to get beyond 240 to get excited. In which case, there's a very strong chance we get back to the round £2 number or 196, which is the lows of early to mid 2012.
Wow.
So we're talking six and a bit year lows. And the trouble is that the story just doesn't get any better.
Right.
They've had to release the stranglehold on Openreach. Got a triennial review on the pensions, which is probably going to show a gaping deficit. Need to be extra funding. You've got big competition on the broadband from Vodafone teaming up with City Fibre. You know, Virgin's going for it, trying to make the UK into more of a digital and, you know, bring us up in terms of world connection. And, you know, it's fighting a big battle. It's had to pay over the odds for the football again in the next round of rights and probably came out with less of it versus Sky. It's had to kind of give up and go with a bit of a cross-selling thing with Sky. So we're struggling to see very positive
So the fundamentals and the technicals
are unfortunately very much pointed to the downside. So if we need something very, very significant, and it might be offering a half-decent dividend yield, but that's hardly making up for the severe capital depreciation we've seen over the last 2 years.
Point taken. Okay, well, let's scare everyone even more now. The FTSE 100 chart, you've highlighted a bearish flag-type formation. These textbooks would say are in the middle of a move, aren't they? Basically, basically everyone's resting, and then you'd get a continuation in the previous direction. This would suggest, if the textbooks are correct, that the FTSE 100 could go a lot lower.
Yes. So, I mean, the textbooks would also tell us that we see a sharp down move, a bounce of some sorts, and then the secondary move should be quite sharp as well. Now, this is far from textbook perfect, the middle section.
But the important thing about the technicals is that they are never textbook perfect, are they? You know, it's around these levels, I always say to people.
You have to go hunting for textbook versions, and it's always very easy in hindsight. We have to deal with what we're looking at today, which was
Good point.
The strong down move from early January, the bounce we saw in February, and kind of again in March. So it's not the perfect flag in the middle, but the flagpole down, and it is very textbook. Whether the second leg lower is indeed the same remains to be seen. But key, I think, is the breach of support there. We can see at 7085, which coincides with the February lows, but also the breach of rising support. You can see the rising line through the middle. That goes all the way back to February 2016. So there is big potential, and this chart may be an hour or so old, but we're definitely testing the 7,690 levels, which we've not seen since, you know, late 2017. late 2016 rather, which could well result in further downside. And one of the things I really like doing on a regular basis, and I would strongly advise it to anyone trading the FTSE or indeed any of its components, is scrolling through the whole FTSE, and it gives you a feeling of where is the whole index pointed. Now you do need to bear in mind some stocks weigh more than others,
Yep.
and there's actually only about 10 stocks which weigh more than about 3 to 7-8%. But you can still get a feeling, and if you look at some of the big defensive, supposed safe stocks which served as bond proxies when interest rates were so low or even negative, QE was decimating the returns. So many of these stocks are now suffering from bond yields having risen, and off the top of my head, the biggest examples I can see at the moment are British American Tobacco, Imperial Brands. Okay, they both happen to be the same sector, but that was very loved, and it is extremely unloved for many, many months, breaching key levels now, which just backs up what we're seeing on the wider FTSE chart. So if we look through, there's so many big stocks have made big breaches of late. Standard Chartered, HSBC, the oil stocks are not looking particularly great, even though the oil price is rising. Because sterling is getting stronger. That's a big hindrance we've mentioned many times.
Okay, so in terms of the flag, what's the downside target?
It's to the bottom there, around 6,700. Again, it's not perfect, but that would coincide with the lows of late 2016, so it would make sense. Fair way to go.
Understood. Okay, let's wrap up with Morrison's. Again, not a great looking chart to me.
Not a great looking chart, but it's one to watch. So there may not necessarily be a trade right now. However, if what we see today, which could be where the day hasn't closed, this is a daily candlestick, you need to see how the day actually closes. If that is what we call a bullish hammer reversal candlestick, it could mean that the shares have seen the end of their current downside, and it coincides with support from mid-November. It could mean that we're seeing the end of that downtrend, a reversal, and a bounce back. Now the bounce back probably wouldn't get all the way back to the high 231s which we saw in mid-March before the whole market turned down, because we do have a longer term trend line of falling highs that is coming across. So nonetheless could be upside to 225 by the time we get the reversal, so that's still 10% upside, which is not to be sneezed at when the wider retail market, the high street struggles are not to be dumbed down.
Yep.
Within the supermarkets, huge competition from the German discounters, and I think Morrison as kind of middle of the road versus the German discounters and the bigger Tesco's and Sainsbury's is very well placed to fight both ends of the spectrum, if you like. So that would be a positive in terms of backing up the
Okay, so a
technicals.
key chart point and actually quite a nice shop.
I think if we get a break above 210, you could be quite confident that we're seeing a big turn and
Some
a
sort of
potential
base.
reversal. Yeah.
Mike, on that note, thank you very much indeed.
Thank you.